Hello and welcome back to Unobtainium Coins and Collectibles. Today we're going to be talking about the gold and silver ratio and how it applies to silver stacking. As you can see right here, we have a gold maple leaf. That's going to be our 1 ounce gold. And to the right, we're going to have some silver eagles. And over the course, I'm going to pull out the amount of silver eagles that it takes to get to 1 ounce of gold, being the gold and silver ratio. But first, let's discuss this. And we're going to use an article by mining.com. And this is an older article, but it's still applicable today. This is from September of 2018, when the gold-silver ratio was very similar. However, it's pretty close to where it is today, and I want to cover this article. So the gold-silver ratio has been one of the most reliable technical buy indicators for silver. Whenever the ratio climbs above 80, the gold-silver ratio is now spiked above 85. And as of this writing, which is April 18th, 2024, it's currently 83.5, somewhere around that, which is the highest level of entire 18-year bull market. In fact, you have to go back 27 years to 1991 for the ratio to be higher than it is today. Now, we're going to have about 4 tubes of silver eagles here, and it's going to have 4 extra on the side that I'll be bringing into the picture here in a minute. The story goes on. The gold-silver ratio, powerful trading signal that can help identify buying and selling opportunities in the precious metal sector. The ratio represents the number of silver ounces it takes to buy a single ounce of gold. It might sound simple, but this ratio is more powerful than it may seem at first blush. In Roman times, the price ratio was set at 12 to 1. In 1792, the gold-silver price ratio was fixed by law in the United States at 15 to 1. Now remember, we're currently at 83.5 to 1, and the United States set that at 15 to 1. So imagine all these silver eagles here, how many ounces of gold you would have at a 15 to 1 ratio. It'd be unbelievable. Over the past 20 years, the ratio averaged right around 60 to 1. Thus, the current ratio is 83.5, is very high historically and near 60% above the 20-year average. The ratio is signaling that silver is extremely undervalued relative to gold at this point in time. That's a very good point right here. Yes, it is completely undervalued. I've talked about this in other videos where silver is one of the best values in metals as far as investing and stacking because it's so undervalued. Compared to where it's been over the course of time. So as you can see here in the video, here's 84 ounces of silver, representing that 83.5, and here is 1 ounce of gold. Those equal the same thing. Now, what would I rather have? I'd rather have the silver, because look at that ratio, it starts tightening up, then we can see where we're heading and how many ounces of gold you can actually get once you start breaking this down. So we're going to go on here. The all-time high of gold and silver ratio occurred in February of 1991, at the height of the economic recession. The recession of early 1990s lasted from July 1990 to March 1991 and was driven by the restrictive monetary policy and Iraq's invasion of Kuwait in the summer of 1990. The latter drove up the world price of oil, decreased consumer confidence, and exacerbated the downturn that was already underway. So what we're going to do here is we're going to pause this here in a second. We're going to look at this video. And we're going to show you what the actual ratio was on a chart here. And I'm going to show you here real quick here. I want to put this coin down here. And now you can see, here's 1 coin. Here's how many silver eagles you get. All right. So let's talk about this chart. So I'm going to throw this chart up here. This is the gold and silver ratio chart, and it goes back to 1999. This just this particular chart. As you can see, in 1999, you had about it looks like about a 58.27. That's 58.27 ounces of silver for every ounce of gold. And of course that dropped down in the, close to 2000, about 46.98. Then it went all the way up to 82 and 0.11. So that was 82 ounces of silver just to get 1 ounce of gold. And then of course just a short year and change later, we're down to 51. And you can see it fluctuates up again, down again, up again. Making it around little after 2006, it was 43.8. Then all the way up during the Great Financial Crisis to 84.38. That's a big number. That's basically a little higher than where we're at right now. As that came down, we got into gold hitting a new all-time high price. When that happened, silver followed after and followed more vigorously. And as you can see, we go all the way down to 32.01 ounces of silver per ounce of gold. So if you think about it, you're having all these silver eagles that you have right now. Let's say you have, 96 silver eagles. And right now you can buy 1 ounce of gold and then just a little, maybe a tenth or something to trade another gold piece. Go to that 32 range and now you're talking 3 ounces of gold per trade. Now, if you go into a coin shop, they're probably not going to give you exactly a 32 to 1 trade. They might make it a 33, 34, 35. Obviously, they're going to cover their spread and give themselves a little profit. But you get the idea. When it gets down there, that's the time when you want to start swapping your silver over to gold. And what that does is it locks in your wealth, what you have held in that silver, into the gold. And then once that gold ratio starts heading back up again, and as you can see, it goes all the way up to 2016 to 83.13, that's when you want to start, accumulating that silver again, because that's when it's the better buy, right? So we're going to click back over here to the video, and I'm going to talk a little bit more about this gold-silver ratio. So in the past, the gold-silver spiked higher during times of economic instability or recession. This makes sense as gold generally viewed more strongly as a safe haven asset than silver, and institutional investors move funds primarily to gold or dollars for safety. Furthermore, nearly 50% of silver's demand is industrial, so economic contraction would impact the price more severely. The silver price falling more rapidly than the gold price increases the ratio. Put simply, it takes an increasing number of silver ounces to buy a single ounce of gold during these periods. Yet the current gold and silver spike is happening absent to a major crisis, as economic growth picks up and major stock indices hit new all-time highs. Now, that was written in 2018. In 2024, we have all kinds of calamity in the financial markets. The banks are underwater. We have the highest national debt of all time, trillions and trillions of dollars. We're spending over $1 trillion every 100 days here in the United States, and that amount of spending and debt is unsustainable. And eventually, the U.S. dollar is going to be forced to be printed, and inflation is going to soar. And when inflation soars, you're going to see a very high spike price on gold and silver together. So the question is the current spike in the gold-silver ratio forecasting another stock market crash? The ratio typically spikes to extreme levels during the depths of an economic crisis or leading up to a significant correction in the equities markets. The stock market is currently very robust and enjoying an unprecedented 9-year bull market, make that about 15-year bull market, with gains in excess of 300,000 for S&P, 400,000 for NASDAQ. So the spike is not driven by the crisis that already exists, increasing the odds that are quickly approaching a major corrections in the markets. Why else would the investors favor gold so strongly over silver during times of healthy economic growth? So, once again, this article was written many years ago, but it's very pertinent today. So as you can see, there's way more going on financially in the markets and in the world and in the U.S. bond market and with the U.S. dollar than what was going on back in 2018. And I would say, and this is not financial advice or no guarantee, but I would say we are due very soon for a market correction or crash of some kind. During that time, gold and silver is going to be one of the best ways to hold your wealth as everything else is starting to evaporate. So right now you're looking at 83.5 ounces of gold, ounces of silver per gold ounce. And if you hold on to it long enough and you keep stacking long enough, you want to wait for that ratio to go down and wait for the ratio to go down. I know a lot of people around 30 to 1 are going to be cashing out a certain portion of their stack. I think some people are waiting for it to get to 20 to 1. Frankly, I think that's very optimistic. But then again, in this market, you really have no idea what's going to happen, especially considering how much debt the U.S. is currently involved in, and what the bond market's screaming, what the currency markets around the world are doing. There's just a lot of calamity, and really nobody knows what happens in the end. But in my world, I'd rather have gold and silver all day long over U.S. dollars sitting in a bank account. And that's just the way I see it, and that's just the way it is. So anyway, thanks for tuning in. I wanted to give you a little breakdown on that. I hope this wasn't too boring, but it was an article that kind of breaks it down and it tells you really what's going on with gold-silver ratio. Again, if you have any questions or comments, please leave them down below. If you like this video, definitely like and subscribe to the channel. I've got a lot of other great videos. These are really more informative videos at this point. I want to try to get those on the channel first, and then we'll eventually rotate into new coin auction openings and things of that nature. So the channel will evolve, but right now we just want to keep the information flowing, and any feedback you have is greatly appreciated. All right, folks, thanks again, and we'll talk to you soon.